How you doing, friends? Ernie here, and this is the final hour to expiration trade. It is Friday, August 5th. It is 2:45, 2:45 for those Gen Zs out there. That, yes, 2:45 does mean 15 minutes before the hour. I know that you don't know how to look at a clock. Just kidding. Anyways, must start the show with a little bit of levity. And today was another very strange day. And we've been having a lot of these as we're in the midst of this bear market rally. So there's the real question. Are we actually in a bear market rally? And what is this bear market rally? It is just so darn confusing. It appears that we are still in this kind of opposite world type of thing. Don't really know because of the way the market behaved today based on economic reports that came out this morning. The employment situation report came out this morning and it was wildly better than expected, which makes me suspicious because every other indication is showing exactly the opposite. For instance, unemployment claims have been increasing steadily every single week for a couple of months. And then all of a sudden now double the number of jobs were filled in July or June, I guess. So I don't know if does that mean peak employment? Just like we have this peak inflation thing? I have no idea. I really don't. But it was really amazing, and the reaction of the market was just mind-boggling. I don't get it. So that makes our job, relatively tough. I mean, we like to say that we're analyzing the market and figuring out the market structure and where's the most likely place for the market to go given those energies that are coming into the market. But when the market has no clue or acts erratically or unpredictably, it really doesn't matter where you put your trade. You can put it up against some sort of backstop that you think is going to be there, either above the market or below the market. I don't think it really matters. So all that really matters is that you play those odds, right? I don't know how else you can do this. You just play the odds. You just think whether I put it above the current market or below the current market, there's going to be some chance that price is going to come near my position. And with that, then you have to wonder, do I try to do any kind of analysis? Is that really useful? Because maybe if I'm doing an analysis and for whatever reason my thought process isn't in sync with the market, even if the market is just all over the place, then I could potentially either be right a lot or wrong a lot, but probably not some sort of normal distribution of, right enough times. So either you're going to be incredibly lucky or you're going to be incredibly unlucky. And we see that pan out too with some people in the service, because at least in these past few weeks since we've had this bear market rally. Before that, it was so much easier. We pretty much had a halfway decent idea of where things were going, and our win rate would be like you would expect, around 50% or so, which is great because a 50% win rate in this strategy is like off the hook. But if it's when it gets down to like 30 or 25%, it's stretching it a little bit. But the good part about our strategy is that the risk is still super small, so it doesn't really hurt you. You have some drawdown, but it's not like tremendous. So long as you pay attention to your position size. If you trade small, then it doesn't hurt you.
Returning visitor.
I mean, it hurts that you have a small drawdown and everything. Nobody wants a drawdown, but it's not like, catastrophic or anything. And so what we're hoping is that, we can at least get some semblance of an idea of where we're going, so that, you know, we can get the win rate up to about 40%. 40%, this strategy, like I said, is a killer. 50%, it's off the hook. Anything over 50%, it's crazy. I remember last year we had a span for about 6 weeks, I'd say. And we were, you know, just nailing it day in, day out, you know, and we actually had for that 6 weeks, you know, 80 to 90% win rate. And it was just crazy, pinning the trade almost at least once a week. It was nuts. But I think that had a lot to do with the nature of the market. It was trending and going in one direction, and that made things a lot easier, more predictable. And, you know, you could have a better chance at hitting your stride. But in this market, instead of me talking, let me just show you what I'm talking about. All right. So then you get an idea. So up to the charts. Oh, missed the button. Let me do that again. Off to the charts. There we go. All right. So check this out. Here we are. Look at this candle here. That is a fantastic candle. That's when the jobs report came out. All right. All right. Now look at the response to that. That is when the market opened. See right there at 9:30. So the jobs report comes out at 8:30. The market opens at 9:30 and goes straight up. Why? 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 We have to get like a recording of a little kid. Why? Why? Why is this? Why? But you know, let's expand it a little bit to a 5-minute bar, so it just adds a little bit more flavor here. So, anyways, before the market opened, I did a little, you know, my regular analysis, and I picked two directions. I picked a bullish and a bearish, and they weren't very detailed analysis or direction picks, right? I just figured that, hey, either the market's going to reject this idea and go up all the way, and I guess that was right. But see, these directions that I'm picking are supposed to be by the end of the day. You know, where are we ultimately going? Because if you choose this direction at the beginning of the market open as it's rising, and you think, okay, it's rising and it's probably going to rise and then do one of these sort of grind into the top, right? You're not expecting it to do a full-on reversal and then another reversal. So, you know, you pick a direction. Hey, we say, okay, S2 looks like the scenario. So we go out and we just pick S2 and place some position up here and hope that it comes up. Now, when it comes up this early in the day, we don't have yet enough premium decay for the position to be worth anything. So you'll be sitting there and, you know, you might be up like $10, nothing. And then all of a sudden it reverses and you go, oh, missed out on that. But, you know, you look at it and you say, okay, it moved completely away from it. You know, is that a good opportunity maybe to add to the position? So I did. I added and lowered our cost basis. If it doesn't cost you anything, if you're trading small and then the first trade doesn't appear to pan out and then it pulls away from you, but there's no clear idea of why it pulls away to you, that's a good opportunity to add to your position, because you can get in at a much lower price and then lower your overall cost basis. Double the potential profit, but actually lower the cost basis. So you can go from like a 1 to a 7 risk to reward to like a 1 to 10 or a 1 to 12 risk to reward. And so now you're putting on, instead of putting on, say, $75 to make 500 or 1,000, now you're putting on $100 to make 2,000. So you see what I'm saying? By lowering your risk to reward. So that's generally what we did. Now, I felt that as we were coming up, not only did we, I wanted to protect. I thought, oh, it's coming up too fast. It might overshoot. That's what I thought. When the market opened, it started coming up like this. I put the strategy on. It kept on going, and I thought, man, it's going to overshoot. And so I thought, hey, I put another strategy up here that would protect for the overshoot and protect a strategy that I call gamma hedging. In fact, there's a video that I did not too long ago, last week, on gamma hedging. You might want to go check that out. And so I did something like that. It didn't cost a lot, and it was protection in case the market just kept on going. And then it of course reversed, and so I added to this position and reduced my cost basis. So then when it came back up, it stalled up here. I thought, oh my God, it's going to come back up and come right into the meat of my strategy. Now it's further on into the day. There has been some premium decay, so now the strategy is actually worth something. Plus, I doubled down on it, so it's worth even more. So I took it off there with some profit, and that covered the gamma hedging and everything, and made a small profit. So it's okay. And now it's going down again. You know, go figure. But these swings are huge. You know, multiple swings in a day. It's this market has absolutely no idea. Now, you look at this and you try to analyze it based on the employment report that came out, which was fantastically good, which makes me suspicious. And that's a terrible thing to say. And I hate to sound like a conspiratorialist these days, but that's the way I feel now. I mean, this is, you know, the Fed, the agencies, the government. I mean, everything that they do seems to be like a big lie. So I don't know. Maybe the report is true. Maybe it's real. I don't know. The fact that I'm questioning it really bothers me. But anyways, it was a good report. The market goes down. You say, okay, so now I have to figure out the narrative of why the market thinks why the price should go down on the heels of a really good report. Why? And, you know, of course, this is one of those opposite world type of things. And you look at that and you say, okay, market's going down probably because the Fed now is looking at this as being super strong in the job market, which means that that's going to contribute in their mind to inflation. Therefore, they have to continue or accelerate their interest rate hike ways, right? So that would be my thinking. That would be my thinking. Why else would it, why else would it go down? Okay, so you get that idea. And then when the market opens, it goes straight back up again. And you're saying, okay, maybe the futures guys before the market opened thought that way, but then the equity guys when the market opens didn't think that way. So now we have two classes of traders and investors that think completely, they're polar opposites. All right. And then when it reverses again, you're thinking, okay, maybe now they're all like a simpatico, right? They had a meeting, they went to lunch, they said, yeah, it's good or it's bad. And then they all decided to go the same way again. It doesn't actually happen that way. I'm just making that up, but it is very confusing. And then of course it goes up again, then down again. I don't think anybody really knows why they're going up or down. They're just seizing the opportunity. Price is going up. Hey, let's go with the up. Price is going down. Let's go with the down. And that's not generally how we're trading here. We pick a spot and either it hits or it doesn't. If it hits, that's great, right? If it doesn't, then we have a very small risk on. It's not a big deal. There are some cases where we might put the opposite trade on if it goes in the other direction. But in these days, why chance it? You know, because it might just reverse back and your original position might be fine anyways. Then you're just throwing money away. So if I'm going to throw money away, I only want to throw it away once is the idea. So that's basically what we did today. So then just a little while ago, I asked everybody in the service to tell me what do you think between A, B, and C? Where will we end? Where is more likely? Which direction? Will we be closer to A, to B, or to C? All right, do you see those there? And these two orange lines, they depict the top and bottom of a very large value node or volume node that has been forming for a long time. And we've been sitting right in the middle of it. And of course, this movement almost perfectly traversed that value node from top to bottom. And now it seems to be settling in on the POC. That's what appears to be happening. You know, of course, it's there's still a whole hour to go. So who knows? Anything can happen. And usually does. So anyways, what was the result of this? I don't know how many. There weren't a lot of people that chided in. I think a lot of people are just frustrated with this market and just saying, but let's see. Yeah, not a huge amount. Okay, so 10 people said B, 11 said C. So nobody thinks that it's going to go up, and a slight majority think it's going to head down or stay in the middle or go down. Now, I like doing these polls because more often than not, our members, their collective intelligence is right? And so that's why I do the polls. So what they're saying then is that the majority of people think it's going to either be B or C. So if you averaged it out, so maybe it would be somewhere between, like 41-20. Okay? That's my thinking here. And so that's why I'm going to choose a strategy that's right around that point, right around there, 41-20. Yeah, that'd be good. So let's see if we do something like that. Here's that gamma hedge trade. All right. That's the gamma hedge trade. I bought the short strikes back, so now we have this. Just in case it does go up, then I can profit on it. Anyways, let's get rid of that. And we'll look at 41.20. And look at the volume on 41.20. That's the highest put volume. No, the highest put volume is actually 4100. Where does 4100 sit? 4100 is at the very bottom. That would be C. So the options traders are choosing C, or the majority of them are choosing C, and then the rest are choosing B, just based on the volume of puts. Right? So here's 20. There's almost 34,000 contracts, and then here's 4100. So this is 4120 is B with 34,000 contracts, and 4100 is C with 50,000 contracts. All right. Does that make sense? So maybe somewhere, actually B is a little higher than that, right? It's really, but that's their B. That's, maybe it's where I put B and C, I guess, is irrelevant. So maybe between those two, right? It would be right on this 30,000, 4110 is the right place to put it. I don't know. Maybe the people in the peanut gallery can chime in here. Let's see who's there. Yeah, we have Mr. Sky Dweller. How you doing? And is here. 123 Happy Street. Steve, how you doing? Hang early morning orders. Get in low. Yeah, that's pretty much it. If you have no idea, put these nice risk to reward trades on that don't cost anything, and hey, if you hit it, you hit big. How you doing, Tim? Yeah. See, this is important. It really is important to play that risk to reward, the asymmetry. It makes a difference, especially in this market. Don't think that you're smarter than the market, because we're not. As if the market has some sort of intelligence. Maybe it does. And hi, Craig. How you doing? Yeah, that's what I had said earlier. I think that was the consensus, that a really good unemployment report means the Fed can go heavier with their rate hikes. But that doesn't explain why we reversed. So Tim is saying B. Skydwell is saying B. Vadam is saying B. 4110. All right. How you doing, Dan? Steve the Wild Man. Oh, wow. Cool. And Taylor. All right. So we got a full complement of trading pundits. So 41.10, it seems like that's the way to go. So if we were to define a fly right there at 4,100, let's see what that looks like. Yeah, I like those odds. Look at that. 20 cents. Can we go 10 wide? Let's try going 10 wide. Yeah. Oh my God. Just 85 cents for 10 wide. That's fantastic. All right. Let's do that. We'll copy that trade. We'll put it into the chat. All right. Well, it says 90 cents, but I like, well, now it's up to $1. Maybe we're acting too slow here. Of course, I have to go to my Fidelity account and type all this in. Still faster than going to a Fidelity Active Trader desktop and trying to type it in. It's actually faster on Fidelity's web-based trader. All right, expirations today. Strike is 41.10. Make it 10 wide. A put, one contract. Buy to open. Fidelity saying $1.03. That's not bad. That's about a 1 to 9. So if I put $1 and see if we get filled. Oh, now it's saying 88 cents. So it just moved back. So you got to, sometimes you have to wait. And now 90 cents. All right. I like it. I like 90 cents. I'll go for 90. Let's see if I can get it. Jeffrey says he filled at 90 cents on Interactive Broker. Oh, I just heard the ding. That means it filled. Yep. All right. We're in. Now let's see what happens. Will we move down between B and C? So let's see here. We'll go to the charts and we'll redefine our little tool. Short strike at 41.10 and 10 wide. All right, there we go. There it is. Let's zoom in on that area. Oops. All right, there we go. It looks like an okay trade, but this doesn't look, you know, we came down here, we're consolidating. Is this a continuation pattern or is this a reversal pattern? Who knows? I don't think patterns matter anymore in this market. Patterns be damned. And let's see, we'll go to our risk graph. Here we are. Here's price right here. Very little risk, $90 to make 800. What is it down to 70 cents now? Holy crap. All right, I just set it to 90, so it's actual. All right. See, if I just waited just a few more that makes a big difference. That that $20, that $20 would change the risk to reward dramatically. All right, we have a late comer. How you doing, Kevin? Yeah. Timing is everything in this game, especially in these asymmetric trades, because when you think about it, look, had I put that trade on now, it would be going on, it would cost 60 cents. All right. And now the risk to reward is completely different. So now with a, here, I'll do the calculation online here. So a 10 wide has $1,000 potential minus the debit. So if the debit is $60, that means you can potentially make $940. Divide that by 60, and you get the risk to reward, 15.7. So the risk to reward on the trade, if you open this trade right now, is 1 to 15.7 or 1 to 16. All right. So if you were to make money and it moved inside here, you'd be really leveraging your money. Now, 1 to 9 is not bad. I mean, that's what we did. So we did this. Our trade was this: 1,000 minus 90 divided by 90, and that's 1 to 10. So that's not bad, right? But look, price keeps on going up. Yeah, I don't know. Maybe maybe price is poised to go up, and the options chain gang is wrong, and all the people in the service are wrong. The chain gang, what I'm referring to, are the people, whoever took these trades. Well, I mean, if you look at the call side has some bigger numbers. So the big number here is 41,000. The big number over on the call side is 57,000. And let's see, 19, 31, 30. So it is definitely heavier on the call side. You know, we've tried to use that as sort of a marker, and it's very inconsistent. It's similar to when you're trying to trade based on max pain, which some people will claim is a valid trading strategy to place your target near max pain, because that's the theoretical middle between puts and calls that will produce the maximum amount of loss on both sides. And so by choosing max pain, theoretically, price will tend to gravitate towards that, because you have that basically a tug of war, and that's where everything centers. Okay, let's see. We have some more people coming on. We have Greg. How you doing? Let's see if Adam has a question. How close is today's market to a no trade decision in your view? Well, in the beginning, it looked like a good decision. So I would say that, you know, in hindsight, it's like, screw this, I'm not trading that. But in the beginning, when the market opened, it looked like a great decision. You know, huge move down. Market opens, it's starting to scream up, going to close that gap, fade the gap, right? Put it up there, and if it moves up high, it should move up high fast and then sort of grind its way to the close. But no, it went up there and then turned around immediately and went all the way down again. And then came up again and then went down again. And now is it going to go up again? I don't know. So yeah, in hindsight, it's like, I don't want to be involved in that. Brian says, I got in XSP at 80 cents, same strikes. Is that good? It's better than me. That's all I got to say about that. Let's see, Kevin, should come down, VWAP in line with moving averages, should end about where we sat for most of the day, in Kevin's opinion. All right, well, Kevin made a good call yesterday, so we're going to leave this all on his shoulders today. If it doesn't work out, just ask me. I'll give you Kevin's home address. Just kidding. Got to be careful what you say on YouTube. How you doing, Jim? And Ken Min, how you doing? There's Chris. You're welcome, Vadim. Oh, Dan, he's bringing the heavy artillery. He's using his superpowers to move the price. Well, there's a lot of time, Brian. It is only 3:15. So there's plenty of time. So Ken's still in his 4150 call, 10 wide. I hope that works out for you. Oh, okay. So no skin in the game for Kevin. So don't pay any attention to what he says. Oh God, Brian, you know, when somebody brings up technical analysis, they get slapped. This is me slapping you. MACD is BS. Hey, Nita, how you doing? First timer here, 41.15, 10 wide at 75 cents. Good luck. Hi, Dietrich, how you doing? Hello, just found your channel this week. Glad to have you aboard. All right, is waiting for the push to 41.40. Then we'll grab a 41.30 if the risk to reward is right there. And Randy is saying, took my first butterfly spread today, catching a reversal up, made 90% on the spread. I'll start journaling these trades and see how they perform as a whole at the end of the month. That's exactly what we profess here in our group, in our service. We encourage everybody to journal every trade, to log all of their trades, to evaluate everything on a weekly and a monthly basis. And then you also, when you journal, journaling is more than just talking about the mechanics of the trade and whether or not it was a good decision and all that stuff, but it's also the environment that you're in, your mental condition, whether or not you're tired or not, anxious, whatever those things happen to be, or if maybe you second guess yourself or something caused you to get off your game. Anything like that is important too, because over time you're going to see patterns develop or emerge from your journal and your performance. And that's an opportunity to create habit correction devices or, employ your habit correction process. And so that you can get back onto the right path of what you hope is your ideal process. And that's to make good decisions, the same decisions in the same consistent manner. All right, I haven't even looked at price. Where are we going? Oh, it's coming back down. So where did I put the trade on it? I put it way down here, huh? Because that seems to be the midpoint of the options guys. I should have put it like halfway between B and C. That's where I originally did it. And then I said, okay, halfway between what the option guys consider B and C. Yeah, I don't like the look of this. You see how this is curling up? That usually is an indication that it's going to break to the upside. That little curl right there, that little curl. See, you got it here too, a little curl, and it moves up, this little curl, and then it breaks up. I don't like seeing that. I've noticed that at the end of the day, when you see that that little, drops down to a consolidation, and then it starts building and churning and then curling up, and then it just takes off. Not all the time, but, it's a pattern. I don't know if it will happen here. Anything can happen, Somebody could say something on CNBC or something like that and change the whole character of the market. So there was a mistake on the P&L on the thumbnail. I went back and retraced all the trades, and so I'm going to bring that up now so you can see that. Well, this is my personal performance in the strategy for the past 45 days. This sideways action here is all during the bear market rally, right? Just can't break out. Before the bear market rally, it was like, yahoo-y! And then bear market rally comes in place, and it's been really tough. Just can't make any headway. So let's bring up the final hour log. All right, so let's look at the dashboard. So we had 18 days, 12 trades, super low profit factor. We started out really well, and then just a series of losses. And then yesterday was a small win. So we're hoping that today will be a winner for us, and we can start on the mending ways again. But after 12 trades, we're only down $62, so it's not like, it's the end of the world. And this is really the benefit of trading small with good risk to reward, so that your reward totally outpaces. So even at only a 25% win rate, we're essentially what someone might say is flat, all right? And if we can get that up to about 35, 40%, we'll start cooking. You don't have to win a lot in this strategy. Just need a few winners. So that's where we're at right now. And the drawdown, in this account, I've got 10 grand, so the drawdown has been as much as 4%. And that's, that's medium. For this strategy, a lot would be 6 or 7, or approaching 10, that would be a lot. Which I think for most traders, a 10% drawdown over a long period of time would be fantastic. Generally, we're much lower than that. So, for instance, and of course, this log that I have for my stuff in the room, it's not, it's only 45 days. But so far, I've reached about 3% drawdown, and that was just recently. And just had a string of bad trades, and a couple of good ones here today and yesterday. Yesterday was a very small one. Today was a small one. So it hasn't been like we're ripping the cover off the ball during this bear market rally. It just seems there's something about it. There's something about it that makes it very difficult to trade. I mean, I don't know. I mean, most other rallies or trending markets up, this strategy is killer. But this bear market trend up is just very difficult. But I'm still up. I mean, I guess that's the important part. Up, about 9% on the capital. So there's that. And, it will all come out in the wash as we keep on doing this over a long period of time. Yeah, see, we're getting that curl, getting the curl. And we only have 35 minutes left. Yeah, I think that this is going to break and probably come right up to this here and then break higher. Yeah, ever since we put it on, it's been going in the opposite direction. All right, so Jim's got a 41.25 5 wide. So he's looking okay, actually. Same pattern on a smaller time frame. They've been doing it all week. Should come down. Well, thank you. You know, I feel much more confident now, Kevin. A little last minute sell off would be helpful this time for a change. After all, it happened before. Yeah, it has. It really has. We've had some big sell offs, you know, right at the very last 5 minutes. And this is the end of the week. So I don't know what that really means in terms of institutional traders and investment houses. They don't care if it goes up or down. They make money either way. That's because the majority of their trading income is coming from their market makers who are trading pure arbitrage, meaning that it doesn't matter what they do, they make money because they make their money on the spread by providing liquidity to the market. That's what their job is. Cowboy Z51 is just curious, besides completing an experiment, would you consider inverting your setup to sell higher, lower, and buy 2 middle strikes as that would potentially yield an 80% win? Would you consider inverting your setup? You mean taking another trade? Inverting your setup to sell higher or lower. Are you talking about putting on a second trade? Like what we call the Batman trade? So in other words, you bookend price. And so if it goes higher or lower, that'll bring up your potential for profiting. Well, there are two things about that. One is that you'll also lose on one of the trades, so you'll be changing your whole risk to reward. The other problem is if you end up in the middle, then you lose twice. So we've tried this before, and we've done this experiment many times, and it's just not worth it. Just take small risks. Sell 41.20 and 41. Oh, I see what you're saying. In other words, put on a narrow iron condor. And so increase your potential. If you could do it so that you're still... See, the problem is that it's not increasing the size of the width that is giving you that. It's still the risk to reward that you're trying to get to. And so, yeah, you could increase the width of your spreads by having 2 short strikes, you know, maybe 1 strike apart or 2 strikes apart. But your risk to reward is going to suffer a little bit, and you still have to put it out of the money. So it really doesn't matter. Now, I thought you were talking about the old Batman trade where we bookend, put a bullish trade and a bearish trade on. And that works sometimes. If you have, like today, a Batman trade might have worked, but you would have had to have been very prescient to be able to put it on, anticipating that price would go only up so high and only down so high. More often than not, putting on the two trades instead of giving you double the chance of profiting actually gives you double the chance of losing. That's what it comes down to. It's going to break out. Look at that. It's going to break out. Darn you. Right at 41.40, it's going to break out. It's going to break. I can feel it. Don't break. Hold on. I have to put on the voice changer and fix this. What are you doing?
Stop that. Stop that now.
Hopefully that worked. Tim Dodds is a seer. He thinks that it's going to be A. So he had a 41.55. Sorry, Shreems. We love free rides, Tim. So what a free ride is, it's a position sizing strategy. And that's where if your maximum profit can allow it, and you can put on more than one contract, and you can, if you're in profit and you can take on or take off a number of those contracts, so you're still left with some, but you take off enough that are in profit that guarantee you a profit no matter what happens. We call that a free ride. Yep, there it goes. It's going to break, just like I said. It's going to break. It's going to get up to, I don't know. I'm going to guess and say that it's going to get up to right at the top of this value node. It's going to consolidate right here. And then into the close, it's going to drop. But it's not going to drop far enough for us to profit. It's probably going to drop. It might. You know, it might. It only has to come near 41.20 for us to profit. Or maybe it won't break. All right. Vadim is an optimist. That's good. Always smile. Smile when nobody's even looking, because it will make you happy. So for those that are new watching these trades, let me explain what we're doing here. we employ a number of different strategies and methodologies and an underlying philosophy that has to do with this asymmetry. It's a lot of this is taken from the works of Nassim Taleb and his basic philosophy around asymmetry and anti-fragile, things that gain from disorder. Is it going to break or not? So anyways, we look at asymmetric trades, very low risk, high potential reward, as having a long-term positive expectancy. The benefit of it is that you maintain very low drawdowns, and while your win rate happens to be small, you don't get that big volatility in your equity curve. You tend to step. So you might go sideways like I'm doing now, and then maybe go down a little bit, and then you catch a leg and you move up, and then you go sideways again, and then move up, sideways, move up. All right, Taylor took something a little higher up, taking advantage of the situation with a 41.25 5 wide for only 35 cents. We've got a long ways to go down here. See how far out we moved? Look at this. Our strategy is worthless right now. Let me see. Is it worth less than 5 cents? I got to check in my Fidelity. Let's see here. All right, so it's only worth 7.5 cents. I'm going to try to sell it for 5 cents. See if I can sell it. That way, if we do move down fast, I will have a much better chance of profiting. Because then I'm sorry, I'm going to buy it back, not sell it. Because then it will look like this. And so if we have a flush, then I will profit much better. Okay, let's see here. Let's see if I can the order's still open. I want 7.5 cents, but I can't do 7.5 cents. I could do 10 cents. Should I go 10 cents? Then I'm putting $10 extra into the risk. What about that MACD? What do you want me to say about MACD? It's bullshit. What is MACD going to tell you? You're going to use 2 lagging moving averages and their difference to tell you where price is going. All right, Joe wants to know, why can't TOS be used effectively for the volume profile? Because their implementation totally blows. It's not accurate, and it's very difficult to manipulate. That's why. That's exactly right. The MACD equals the trend 15 minutes ago, and we're working in minutes, not 15 minutes ago, but right now. I know, technical analysts, because that's all they know, and they don't know that, I've run a hedge fund and an automated strategy with high net individuals and have tried virtually every automated strategy known to man and every technical indicator based strategy, and none of them are better than a coin flip. None of them. They don't work. We haven't got that breakout yet, but we're running out of time. We only have 18 minutes to go. So we need that move down. So the only way I'm going to win, really, I think, is if I buy these short strikes back for 10 cents instead of 5. And just take on that slightly extra bit of risk. That was my fill. So now my strategy looks like what I just depicted here, just like that. And so if we do fall, I have a good chance of making something. Yeah, Joe, I really tried making volume profile on Thinkorswim work, but it is just a horrible implementation. TradingView is so much better. It's for the price and for the completeness of the platform. It is just, the only thing with TradingView is obviously it's a subscription in order to have volume profile, and you have to buy the real-time data, which costs an extra couple of bucks a month. Yeah, we're just going in the wrong way. Just going the wrong way. Come on. Well, yeah, when I look at the chart, that is TradingView and its volume profile. See, Thinkorswim doesn't even have a view by visible range. And that is, in my view, the most useful feature of volume profile in TradingView, because I can just move price in and out, and the volume profile automatically recalculates. That does not happen on Thinkorswim. Brian says it's because the market is getting ready for the next big down leg on the bear market. Hopefully. We'll see. Starting to break again. Yeah, and what I'm showing when I'm showing the risk graph, that's in TOS. That's in Thinkorswim. because Thinkorswim has the best analytical mode for options. I mean, there are some platforms that cost a lot of money that you can use to do that too, but everything is integrated with TOS, and it's one of the best options trading platforms there is. So there's the breakout that I was talking about. All right, and I said it would come to the top of this value node, and then come down. Let's see if that happens, or if it will just keep on going. See that little curl up right there? That curl up. Anytime you see that, I think that's tradable. That little pattern there, definitely tradable in the short term. I don't know about the long term, but all right. I think it will come up to this LVN right here at 41.47. That's my guess, or 41, right in there. And then it'll stall there. But it's so far away from our strategy. It just went in the opposite direction as soon as we put it on, opposite direction. Hate when that happens. See, now here's a case where, we use logic and logic doesn't work. The logic was that, most of the chain gang, all those options traders that are putting on trades are all saying that it should come down somewhere between here and here, but it doesn't. Well, on the other hand, you could look at it from a call versus put point of view, and there's definitely more volume on the call side, but we've done that before too, and that hasn't worked. Today it worked. Tomorrow, will it work? Well, tomorrow's Saturday, but Monday, will it work? Tuesday, will it work? Who knows? So yeah, we came right up to the LVN, stopped. All right, so Kevin say, hey, do a last minute trade. Do a 5 wide trade or something like that. Maybe, I don't know. Let's see what that looks like. So a 5 wide trade right here at 41.45. Can't get the risk to reward. Now, if we get a nice little sell-off, I've seen sell-offs with this time horizon that have moved way more than this, but that's asking a bit much. We'd have to get down. It would have to be a move of 25 points. And look at it, it's going right up to the LVN right there. The LVN being this low point right here. Will it break through there? I probably should have put a trade on here when I called the curl. No, I'm not going to chase anything. We'll learn from this, right? So the thing that we'll learn is reinforcing this idea of this little curl move here. That little curl is significant. Maybe we wait. You know, if we ever see a situation where it retreats like this, and then we're left right here. We're right here, and it's 3 o'clock, and we're about to put on a trade. Wait for that curl to happen, and then put up a narrow spread right up onto the next LVN or node above. Yeah, I think that's what I just said. Yeah, this one isn't going to be even fun to watch, you know. At least on other ones, you know, we're riding on the edge and thinking, "Oh, it's just in there. It's just in there." Yesterday we had a win that was good. The 3 trades prior to yesterday, each of those trades I was 100% up and I didn't take the trade, or I was not quick enough. So the whole performance thing could be a very different story if I could just go back and take those back. That's okay. We're learning all about this final hour trade. The big experiment. All right, so Brian is asking me to slap him again. Let's see. Do I have any sound effects for that? No sound effects for that. No, that's not a good one. This one. That was for you, Brian. Let's see, what other sound effects do I have here? What's this one? No, that doesn't work. I like this one. Crickets. What's this one? Ugh. I could do that all day. All right. That's enough of that. Come on, we got 6 minutes to go. How about a big drop? It's not going to happen. No, it's not going to happen. So it looks like the consensus among the members was wrong. They chose B to C. A minority of members chose A, so A would have been the right answer today. All right, what I'm going to do is, instead of like looking at this is like watching paint dry. I'm going to bring the big head back on. Big head's here. All right, we're going to wrap this up because it's the weekend. And I really would have loved to have ended on a big note, but that's okay. We did okay in today's trade, so that's good. As a matter of fact, where am I on that trade? Oh, I got rid of it. I'd have to go over to my Fidelity account and then map it out to see it. All right. Let me quickly do that. Positions. So that would be my 4165 call. Is that any good? Is it worth anything? No. It's worth Butkus. How about the other one? Yeah, it's worth. Yeah, they're not worth anything. I mean, the market would have to go much higher. So they're not worth anything either. So, all right, that's okay. Did well on one of the trades earlier today. And let's go back here. We have some more questions. Oh, closed to 4150, 10 wide for 690%. Yeah, Ken. Ernie, didn't you have a bullish trade from this AM? No, I did. I did have a trade, but I took it off. And I took it off with an okay profit. Had I let it on, it would have pinned. And yeah, it also would have been 690% like yours. But I took it off because the market was way down and it looked like it was going to continue to go down. And I'll tell you where I took it off. Yeah, I'm so mad at that. I was hoping somebody wouldn't remind me of that. But anyways, when as you know, in the early part of the day after the market opened and it started rising right here, I had talked about a trade up here, and I put a trade right there, a nice spread, centered on what was it centered on? I have to go back and look. Orders. Uh, 4150, right at 4150. It was centered on 4150. All right. And I had two of them, 10 wide. So that would have been a spectacular trade. But anyways, I put that trade on when we were way down here. And it went up. And at that, as I explained earlier, in the early part of the day, it wasn't worth anything. And then the market reversed. Back when it got down here, I added another. So I had two total at 41.50. And I reduced my cost basis down to like $1.15 for the spread. It came up here and hung out for a little bit, and then it started to retreat, so I exited. I exited right here. I already recorded it in my log. Let me show you my log. So yeah, so here's the trade. Well, I'm sorry, it was a combined $1.25. And I exited at 215 because it started to move away. It was as high as 250. All right. I had a 1 to 7 risk to reward. I had two contracts and I made $168. That was just a little while ago. I got out of it because I saw the market going down. So thank you for reminding me of that, Ken. I'm very happy for you that you had basically the same trade, made 690%, and I only made 72% because I got out early. And the reason why I got out early was because it started to move away. And I thought, this market's going down. I didn't think that we were going to do this doohickey and come right back up. So that's what happened to me today. And now I just gave away half of it playing the final hour trade, but that's okay. Every day, there's another day on Monday and Tuesday and Wednesday, and we'll just keep on going. I mean, I'm kind of beaten up a little bit, I think, over this bull market rally or bear market rally. The fact that we've been going sideways, so. And, I'm okay with at least ending up with the week on an up note. And I know that if I just keep on plugging through, then eventually I'll be like Ken and hit those 690% winners like I did earlier last month. And some, recently too. I had some good wins. But yeah, today wasn't a fantastic day for me. It's a winning day, but not a fantastic day. So yeah. So yes, Ken, thank you for. I'm glad that you made that money. I really am. Thought we took a similar trade. Yeah, I entered when it was way down at 50 cents. Saw the potential and headed back up towards the previous high of the day. Yeah. I got out. I thought I was being smart by getting out and grabbing the profit that I had after it had moved away from my trade for so long during the day. What I should do is, just let a trade play out, I guess. Oh, Dan says his superpowers worked. That's awesome. Yeah. So that's why I said there's always going to be some people with this market. There's going to be some people in the service that are going to win, and other people that are going to lose, and other people that are going to do okay on any particular day. And but the key is that we all lose very tiny. So that's that. All right, let's go back to the big head. Yeah, I agree. I mean, this market is really hard. It's really, really hard. It was so much easier before this bear market, but but even I could have made a few slightly different decisions, even in this bear market rally, that I know there were some mistakes that I made. And some of the mistakes that I made were taking some of my trades at a much lower risk to reward. And there were three mistakes in particular. And had I not taken those three trades, then I would be substantially higher, not substantially, but about $750 higher than I am right now, which would, bring me above 25.5 and above, well, almost at $3,000 or about a little over a 10% return on the capital in the past 45 days. That would have been nice, but I made those mistakes. And so I'm rectifying that, and I'm not going to allow that mistake to happen again. Now, today, was that a mistake? That's something that I'll have to look at in the long run when I start looking back at my journal and seeing if there's a pattern of me doing something like this, where I give up halfway in the day and just take the profit that I thought I deserve. And instead of holding out, did I make the right decision to get out with less profit? Right? So, Ken says, that's the question, because I've left plenty of 100 to 200% gainers on the table trying to go for more. How do we know when to bail? When you're having these huge days that are going up and down, in my view, it's take the profit when you can get it, because you just don't know if it's going to end up there. But when you have a more regular day, one that maybe moves up and then grinds, or one that is a smaller consolidation or something like that, or a trending move, or or a reversal and it comes down and then consolidates. I mean, those are easy markets to play. And, you feel a lot more confident about just hanging in there and waiting to see if it pins for you. But when it's just making these huge swings like this, up and down, 40 points up, 40 points down, it's crazy. And you figure, okay, third time's a charm. It hit me, and now I'm in profit. It could start going down again. I could lose everything. So I just say, take it. So I think that's the difference. And then there have been other times, I swear to God, where not that I get distracted, but I'm doing something that prevents me from actually taking action. So, for instance, let's say that I'm doing some work upstairs, and there's contractors, and they're redoing a bathroom, and then the contractor comes in and needs to talk to me, and so I go up there at about 1 or 2 o'clock in the afternoon, just when that point where I would have gotten out of the trade, and I don't get out of the trade. And I get the contractor on its way. I come back and I look at it and go, and now it's just too late to get out. And so I just hang out. And then it turns around like it did today and hits my target, and I make 500, 600, 700% because I got distracted. That's happened. That has happened. And then, I think that, you look at all of these things and how they happen over time, and you log them, and there's only so much you can do. There are times when it pays to make a decision based on the best information that you have, and other times to just, sit on your hands. And so you have to decide over time to see those patterns and find out where you're going to gravitate towards the majority of the time. There's no one answer. That's the problem. All right. Dr. Russell says, I took 3 positions today, including the 0 HTE trade. That's the final hour trade. My second position finished in the profit tent. I got out at 356 for a break even on the entire day. I'm calling it a win, ready for the weekend. Yeah. I'm okay, because for me, net between the final hour trade and the regular trade, I'm still up. So that's okay. The thing that bothers me is that I could be up by 4 or 5 times what I made. And I know that there's no way to guarantee that you're going to make those all the time. And what I want to know is that after looking at those types of situations, and if I, over the course of, say, 100 trades, and I can see 10 trades, I exhibited the same behavior and they ended up subpar, they could have ended up a lot bigger, then in the future, when I have that same contextual position that I'm in, maybe I'll recognize it. I will get triggered by whatever action or situation or context comes up, and I'll make a different decision. And maybe over time, that will make the difference. That's why we have journals and logs. Brian wants to know, which data is faster, SPX or the ES? I don't pay for the data in TradeView for SPX, but it looks real time. ES looks delayed. No, you either get delayed or you get real time. When you pay for it, you get real time. Right? So you can tell if it's delayed or not. It says it right up in the bar. And by default, your ES and your SPX are both delayed. It costs like, I don't know, $2 for the CME group, and then another $2 for equities. So $4, and you get both the futures and the equities or the index per month, real time, with TradingView. So that's what I do. All right. Says, I'm really considering 2 contracts, even with a small account. This way I can go ahead to take that free ride. the trade profits more often than not, it seems. Yeah. So that's a heady topic. And I think, depending on what you're considering a small account, I think that anything under, say, anything under $10,000, it's really hard to take two positions unless you can add to a current position and it's small enough that you still don't violate your max position size and you're able to get in two positions and reduce your cost basis. Under that situation, I can see, taking two positions, but I don't think I would start off with two, and unless it's small enough, right, that it was under a certain percent amount relative to your account size. So that's the way you have to figure it. And then once you gravitate to, say, 15,000, then you're going to have, so for example, from 3,000 to 5,000, I can see taking position sizes anywhere from 2 to 5%. Okay. And that, that's a consequence of having that small account, because even a individual position, it could be $150, right? And so 150 divided by 5,000 is 3%, right? So 3 to 5% is about the max that I would take. You have to look at it from the point of view, if you lose, 10 times in a row, is that going to break you? Because you could easily lose 10 times in a row. And then when you get to, say, 10,000, a single position that, say, cost $150 is only 1.5%, right? And what will happen if you had 10 losers in a row? That's $1,500. It's 15% of your account. Is that going to break you? Probably not. And you probably keep on going. As you get bigger and bigger and stay small, then that equation changes a bit. You can also modify what you're doing based on the size of the trade that you're taking and the risk to reward. And that can modulate your position size. Once you start getting up into bigger and bigger accounts, you want your position size to shrink a little bit. So when I'm trading with a $200,000 account, I usually start off at a point, a quarter of a percent, or even less, maybe 1/10%, and then add to the trade if I can reduce my cost basis and maybe go up to as much as maybe 0.75%, and that might be my maximum position size. And you might say, well, what do you do with the rest of the money, Ernie? Well, it's there in case I want to put on multiple types of strategies, so I have it available. Or I take the majority of it and I put it in and buy short-term treasuries. Go to Treasury Direct and set yourself up an account. Buy yourself, weekly or monthly treasuries and gain some interest. It's actually halfway decent interest. It will make a lot more money than sitting in your trading account, and it'll be totally safe. That's what I would do. And then if there's a really attractive stock or something, you could invest it in that, or a mutual fund or whatever. So this is your entire, and then take 10% and put it at risk. 10%, you put it at risk with this strategy. That's if you have a larger account. That's what I would do. Larger, I mean 25,000, 50, 100, a million, whatever. So in any event, what you should be doing is you should be figuring out what is your max risk. And that risk should be really small, because this is generally what I do. You try to figure out if I'm going to lose, say, 10 or 15 times in a row, which sounds like crazy, but it could happen. How much am I willing to lose? What is my maximum tolerance that I can take, my gut? And then another figure you have to look at is, what is my capacity for risk? How much could you take, regardless of what your gut feels? And then you have to take those two figures and you have to figure out, well, which one are you going to compete with? Which one is going to truly affect the way you trade? And then once you figure out what that maximum is, cut that in half, and then take what's left and chop that up into five pieces or 5 tranches. And then start your trades off with 1 tranche. You might think, wow, that's super small. Yeah, it is. Because you got to remember, we're trading super small so that we can go after huge potential profits, right? And I found that by trading this way, in this style, you can trade with virtually no anxiety, no stress, very small drawdowns, and still in just regular markets like these and others, you can make 20 to 40 to 50% on your capital, depending on how big your account is. Last year, I started with a $3,000 account, and it was a little bit more aggressive because it's smaller, and I was able to bring it up and triple it in size. Don't expect to do that with a $20,000 account, all right? It's not going to happen. But with a $3,000 account, that's definitely possible. Once you bring it up to the 10, then you're at a different level or a different position sizing. So generally, that's how I look at it. I'm looking to make, 1 to 4% a month if I can. This past 2 months, I've made 9%. So I'm like way over what my average should be, even though it's been frustrating and I've been going sideways. So I'm fine, because if you then extended that out, if I did that, throughout the year, and I'm making 4 or 5% every month, you're talking about making 40 to 60% in a year. That's crazy good. Crazy good. If you think that you're going to be a trader that's going to double your account every year with a regularly healthy account, you're delusional. It's not going to happen. It might happen one year, but you're not going to be able to string those years, year in, year out, with that same kind of philosophy and that same kind of trading strategy that you have. It's not going to work. So you need to figure out something that you can dial in and be consistent with. Now, I'm not saying you're going to make consistent profits, week in, week out. That doesn't happen. But I mean consistent over the long term. So that's what you want to do. All right. Hopefully that helps. I want to thank everybody for showing up. Peace to you all, and have a great weekend. We'll see you on Monday. Take care.